A very warm welcome, everyone. My name is Nicholas Tan from Kenanga Futures and Student Berhad. Thank you for spending your precious time to join our webinar today. It's a joint collaboration with CME Group in our effort to create awareness and provide education on listed derivative to the participants. Please take note that futures and options trading involves substantial risk due to leverage factor and may not be suitable for all investors. This webinar is purely for educational purposes. Kenanga Futures Student Berhad accepts no liability whatsoever for any direct or consequential loss arising from the use of the content of this webinar. Next, if you have any questions for our speaker, please feel free to post your questions through the Q&A box on the right side or at the bottom of your screen, and we will attend to your questions after the presentation. Today, we have Mr. Daniel here, and he's going to share with us about trade the CME Micro Gold and Silver futures. So without further delay, I would like to kickstart our webinar by welcoming our speaker today, Mr. Daniel. Daniel, over to you.
Hi, good evening, everybody. My name is Daniel. I'm from Singapore. I have been doing futures for the last 35 years. I have been working with many major brokerages, multi-exchanges, and today I trade practically everything except equities. So today's topic is on gold and futures. So gold and silver futures, basically. So there's a new contract that CME, it's not exactly new, but a new class of futures contracts that CME has been rolling out for some time now. The latest has been the equity index futures, but the micro contracts has been around, especially for gold, for the last decade or so. So without much ado, let me start by my presentation. So like I said, today the topic will be on gold and silver, specifically on the micro futures that CME has. Now, to begin with, of course, the standard disclaimer, futures and option trading are basically speculative products. So they do come with large potential for rewards as well as the accompanying risk. So you must be aware that when you trade products like this, you must be willing to accept the risk that comes with these products, okay? And of course, common sense will tell us we do not trade with money that we don't have. So basically, you do not want to overtrade. So this presentation is neither a solicitation to buy or sell any futures or option contracts. So likewise, there is no representation as to past performances, whether it is trading systems or methodology. So it's only an indication of what you can do. No representation is being made that any account will or is likely to achieve profits shown in this presentation. So, okay. So the first thing I want to ask is why gold and futures? Why gold and silver? Specifically, these two precious metals has always been regarded as money for centuries. In fact, gold has been regarded as one of the must-have assets for as long as we can remember, especially for Asian. We have this affinity to gold. Likewise, the Chinese, the Indians, we are very, very familiar with this asset class. For centuries, gold and silver has acted as gold. It has been regarded as gold because it could store value, so it has performed that role. But over the years, especially after the 1960s, after the World War, it has been replaced by what we call paper money. Paper money is another word for fiat currency. Is essentially a money that's been created by governments as legal tender because it is more transportable compared to, let's say, gold or silver, which can be very heavy. So for the purpose of transportation, paper money has been very dominant for some time already. In fact, after the 1960s, we can see that paper money has been the main definition of what we consider as money. Of course, paper money also includes coins, okay, but we basically will say that paper money is fiat currencies. There came something very interesting because by after the World War, after 1945, the US dollar has been the dominant currencies, and most of the ally has actually shipped their gold to the United States for safekeeping, and that anchored the US dollars as the major reserve currency, and that create stability for the rebuilding of the post-war period. And then by 1971, the then President Nixon decided unilaterally to delink gold from the US dollars. During those days, it was still called the gold standard. For every dollar that they print, it must be backed by gold. Okay, by 1971, President Nixon decided it's too cumbersome because all the nations that have parked their money with parked their gold with United States has been redeeming their gold. So it didn't work that well after until in the early 70s. So we can see that the concept of money has actually evolved over time. Today we talk about digital currency. The next take, if I may, in terms of what is considered money, is going to be digital currency. When I say digital currency, I don't mean cryptocurrencies. Okay, it is something that has been around for some time, but ever since we have American Express rolling out the charge card back in 1972 worldwide, you can see that that is a definition of money. Money has actually gone digital for a few decades already. We all know that if we need money, we can go to the ATM machine. Whatever digits that we can see on the monitor of the ATM machine is basically, we know that it's money. So concept-wise, digital currency has been around for some time now. Now the thing is this year 2020 has been very eventful. It's also what we call, I would consider as an inflection point, because the role of the US dollar, as we can see so far this year, has been one-way track. Okay, since the start of the first quarter, we can see that COVID-19 has actually been a game changer. Not only there's a lot of changes, there's a lot of restriction in social movements in the financial markets. We can see that it's also being reflected. Earlier on, I say 1971, President Nixon decided to end the gold standard by delinking the gold to the US dollars. Okay, that caused the dollar to come off in a very, very sharp way. Before that, we can see that the dollar is actually very, very stable for a good part of 1960s. Okay, then what happened was 11 years ago, we have this global financial crisis in which central banks, principally we have the Federal Reserve, the ECB, and the BOJ, all went into massive QE programs, meaning to say that they have created a lot of money supplies, and that debased a lot of currencies. Okay, so we can see that the role of the US dollars, if we measure US dollars price in gold, you can see that it has been a one-way track. From the late 1990s, we can see all the way up to today, we can see that the US dollar price in gold has basically been on a downward trend. Okay, now if we can expand this back to 1780, you can see that there's a long period of stability. We have price stability all the way up to the 1960s, and then you can see that the price drop off after 1971. The US dollar practically collapsed, and it is still in the midst of debasement, because right now it's even worse. The series of QE program that they launched has pumped so much money supply into the system. The simple fact that we have more supply means the value of the whatever the thing is has actually been devalued. Okay, and then we have 2020. We already have one round of US government has been pumping a lot of what I call the economic stimulus, in which they are trying to get the economy going. So far, that has created another $2 trillion of debt. And all this will come to a point whereby the national debt will be the next possible, the seed for the next crisis. So while we are dealing with the COVID-19 right now, going forward, we know that there are going to be even more crises that we will have to face, basically. Okay, so the reason why I think gold will eventually have to go up, okay, although we can see that since August, after it hit the all-time high, gold has been retreating. But over the longer term, okay, I will show you some charts later on why I believe that gold is still an asset that we all must have, whether in the paper form or whether it's in the physical form. The main reason what I believe is what we are already seeing in the States and elsewhere, whether it's in Hong Kong or whether it's in Europe or whether it's in the Middle East, we can see that there's a lot of social discontent. Okay, people are not particularly happy because when the economy is not doing well, all this will boil to the surface. Right now in the States, we have US presidential election, and this year the election has been very divisive. We can see that there is a trend towards losing faith in their government. And that is, to me, will be one of the main catalysts of why gold will actually be something that you want to hold on to. Not because as an inflation hedge, not because it is some money, okay? And all these two are currently not evident because there's no inflation in as far as we can see for the last 11 years. Likewise, gold is no longer classified as money in the traditional sense. Okay, but what will actually cause gold to rally will be the loss in faith in governments. Like I said, the biggest elephant this year, other than the US-China trade war at the beginning of the year, has always been, beside the COVID-19, okay, this month we know that the US went into a presidential election, which they have to hold every 4 years, and that was on November the 3rd. Immediately after the weekend, not even immediately after the weekend, on November the 7th, which is a Saturday, it appears that Joe Biden, which is the Democratic candidate for this year election, it has been declared the winner by the media. Okay, this is by no means official yet because although the media has called Joe Biden the president-elect, the current sitting president, which is Donald Trump, has not declared that he has lost. So basically, he's still fighting this presidential election. And the market do react, okay? Immediately after over the weekend, when news came in that Joe Biden appears to be leading, on Monday, you can see that the market actually rallied, okay? Because finally, the market has some kind of certainty that knowing that which of the candidate is going to be the next president. Now, the strategy for the current sitting president is to block certification of all the key states. Right now, it's not official because the US election is very, very different. Theirs is not a popular vote, not first past the post kind of a system. Theirs is based on Electoral College, meaning to say that each state would have to elect based on the number of votes that the candidate has managed to amass in order to come up to a decision. So you can see the timeline at the bottom here. Okay, December the 8th, which is like 2 weeks from now, they will have to choose the Electoral College. Okay, then they will meet, and then finally at the beginning of January, the new Congress will sit in, and then they will announce the actual winner, which is on January the 6th. And then whoever the winner is will have to be sworn in by January 20th. So it's still some time away. It's not official yet. Based on the US election, the Electoral College up to yesterday, you can see that the first candidate to amass 270 Electoral College votes will actually be declared the winner. So far, you can see that in this map, you can see there are dark blue and light blues and dark red and pink. The darker color blue and red means those has been elected. The Electoral College has already certified, of which Biden has 106, whereas Trump is at 160. So up for grab will be another 272. Okay, whoever managed to first get 270 votes, okay, 270 votes will be declared the winner. So there is still a bit of uncertainty here. It's just not still not official yet. So all this will cause the market to be a little bit, undecisive as to which way to go. Obviously, the last few weeks we know that both Pfizer and Moderna has actually declared that their vaccines are pretty effective. That's one of the reasons why the market has actually gone up into new high, especially the Dow Jones. The Dow Jones this week has actually traded above 30,000, although now it has pulled back a little bit. So what does Biden stand for? If Biden is going to be the new president of the United States, these are the few things that he has actually been campaigning on. He wants to reverse Trump's tax cut, okay, to raise the corporate tax rate back to 28%. Currently it's 21%. Obviously, one of the most contagious issue for Donald Trump has always been Obamacare, which is the Affordable Care Act. Okay, in this particular act, it seems that ordinary people, okay, even those with pre-existing condition, can buy insurance policies, and Trump doesn't like it. And if Biden is elected as president, one of the things that he will repeal will be this it is to continue to revive back the Obamacare. Then, of course, he's big into infrastructure as well as clean energy. So he has already said that he's going to start for he's going to not going to issue any more drilling licenses for fossil fuel. So he's campaigning on a green platform. So these are his policy. Whether or not he can carry on these programs will be very much dependent on whether they can secure both houses of the Congress. The U.S. Congress is made up of the Senate as well as the House of Representatives. It appears that the Democrats has already secured the House of Representatives, although on the reduced majority compared to before the election. And now there are only 2 votes that separates who will control the Senate. Currently, the Republican has 50 seats, whereas the Democrats has 48. All the Republican needs is only 1 more seat, okay, to win the Senate. If they manage to win, they are likely to block what Biden is trying to push through, okay. But in the unlikely event, if the Democrats manage to secure the remaining 2 seats, that means it will be 50-50 in the Senate. 50 for the Republican, 50 for the Democrats. Then, of course, the next vice president will cast the vote to break the tiebreaker, and that one happened to be a Democrat. Of course, we all know that will be the incoming presidential vice president elect Harris. So this is where we are right now. Like I said earlier on, the difference between the 2 parties is going to be on the 2 remaining seats in the Senate. Okay, and this is up to yesterday. Now, earlier on, when I say when the polls came in, and it seems that Biden is likely to win, okay, on the following Monday, gold actually came off big time. Okay, of course, correspondingly, the equity market actually rallied. Okay, then what happened was conversely, gold actually come off. So because once you have certainty, because traditionally between equities and gold, these 2 are actually belonging on opposing sides. They are inversely correlated. Equities are always seen as risk-on assets, whereas precious metals like gold is considered as risk-off assets. Meaning to say that when people are more willing to take risks, they will go into equity markets. Conversely, they will not want to own precious metals, which is a risk-off asset. So when the results were out, okay, they have some kind of certainty. Equities rallied, gold actually come off. There was a lot of profit taking because gold actually went up to all-time high in the first week of August this year. So you can see that from $1,951.70 on Friday closing, it went down to close at $1,854.40 on Monday morning, the following Monday morning, which is a move of 5%, which is considered a very, very big move. Okay, so up to yesterday closing price, you can see that the market has rebounded back somewhat. Okay, so this is what we call the bounce back up from the November 9th low. It's basically what we call a corrective bounce. Okay, now this is the 1 hour outlook. Okay, you can see, no, sorry, this is the silver. Silver also moves downwards in sympathy with gold, but the move in the silver market is actually a lot wider. You can see that it went down by 7.6%. Gold went down by 5%, silver sold off 7.6%. So the move is a little bit more pronounced in the silver contracts. Okay, so a little bit background on what is happening in the States right now. This is the economic background. Okay, what we are seeing is that it's not going to be plain sailing. Whoever is going to be declared the next president will have to deal with all these issues. US unemployment is way above $13 million because of all the lockdowns at the beginning in the first quarter of this year. You can see that a lot of people were out of jobs. People are not going back to office. They're all advised to stay at home. Then of course we have record bankruptcy because all the small businesses, the mom and pop shops has all failed. More will fail. So there's going to be a record amount of bankruptcy going to be the incoming president will have to deal with. Likewise, a good chunk of the households, 5.3 million, are missing their mortgage payments, so they are behind on the rent. So they are waiting for the second stimulus, which right now is in limbo because both candidates are not willing to push through any stimulus right now until the final results are out. Likewise, the US, in response to the COVID-19, has actually gone into overdrive. Okay, they have issued more debts, and right now the current debt is sitting way above $27 trillion, which is a record for US. Okay, they have never have to deal with such a big amount of debt. Like I said, in the next crisis that we are likely to see will come from this particular corner. Okay, sovereign debt. Okay. Earlier on, I showed you a chart of the US dollars. US dollar continued to lose ground the entire last 7-8 weeks, last 7-8 months. So you can see that the dollar is on the retreat right now. Is the dollar going to be like this forever? I doubt so, because once, even if a vaccine is available and market seems to be able, is buying this news, eventually, we all have to understand while the US dollar is coming down, that means corresponding all the other currencies, the major currencies like the euro, the pound, the yen, okay, they are all relatively more expensive. And that is not good for their economy. They are not competitive, because if their currency is too strong, they cannot export relative to, let's say, the US. So right now there is a bit of a currency angle we all have to consider. US as well as the other major economies right now, global interest rate is almost at record low, okay, and it's going to likely to stay low for some time, and because of that, we will have to deal with a very ultra low interest rate environment. How are you going to play this when interest rate is next to nothing? People are less likely to save. They are less likely to take on more risk, because it doesn't pay for money to be sitting in the bank. They will rather take the money and try to make something out of it, either by playing the stock market or something else. Okay. Likewise, projected debt in the US is likely to increase another 4 trillion when you include in the second stimulus, which is going to be something very, very big. Okay. Earlier on, we say that the corporates and consumer loans, okay, right now are also high, because that will also mean that they are adding on more personal debt as well as corporate debts. On the pandemic front, we can see that the number of cases in the States has surged beyond 170,000 a day. And as of today, the death toll is 268,000, which is a bit scary, because we even in this part of Asia, we don't see these kind of numbers. So earlier on, we said the dollar has been retreating. This is up to this year. This is for the year to date. You can see that at the beginning of the year, we can see that the dollar index is above 96. Now it is trading at the lower end of 90. So you can see the dollar as a whole has actually been trending downwards, and that will impact how gold is likely to move, because you know gold price in dollars is still what we are looking at. Now, traditionally, earlier on, I said equities and precious metals, they are the same, different sides to the same coin. If equity is doing well, means people are on a risk on mode, okay? And if gold is doing well, it means investors are on the risk off mode. But something very interesting this happened this year. At the low of the sell-off in equities in March, both gold and equities both rally. You can see that they are moving up in tandem. Gold peaked in August 7th at a record high of $2,289.20 on the futures contracts. Okay, and ever since he has been falling down, he has been pulling back a little bit, not falling back, he has been pulling back. Year to date, as of yesterday closing, gold is still up 22.5% for the year. Whereas if you have been buying technology stock, you know that Nasdaq has been doing exceptionally well this year. Okay, of all the major US equity index, Nasdaq has been the one that outperformed. Up to last night, it was up 41%, which is amazing, because on the back of the COVID-19, with all the massive destruction into the economy, equity market is still rallying. Okay, so this is the what we are seeing right now. So at the beginning, let's say for example, when gold hit above $2,200, people were scratching their head. Okay, how is it that gold can go up in tandem with equity markets. So they couldn't put a finger to why gold is also rallying on the back of a major rally in equity markets. Okay, so sometimes if you want to look at the news, if you're looking at fundamentals to trade this gold, sometimes you find that it's a bit illogical. Okay, so like I said earlier on, gold rallied because there was a lot of uncertainty, and as equity market is rallying, you can see that during that period there was a period where there were a lot of riots in the streets of America. Okay, so you can see that when there are civil unrest, when there is problems like this, you can see that people want to hold on to something that they can actually feel and touch, something like an asset like gold. Okay, so gold actually benefited because of all these riots going on in the states at that point in time. Okay, so we have no inflation, and gold is not seen as a hedge against inflation. Why is it going up? So later on we will look at it, but in the meantime, for those who are interested to, let's say, buy some gold or to invest in gold, there are a few things you can do. Obviously you can go to you can buy paper, whether you are opening a gold savings account with one of the banks, or you can trade gold futures, or you can trade gold on the OTC markets. Likewise, you can also buy physical, you can buy jewelry, for example, you can buy bullions, okay, you can buy gold coins or gold or silver coins. So basically you have two choices. Either you go physical or you trade paper. Okay, right now in the gold market here, as far as the world is concerned, there are two major things you have to consider. The biggest OTC markets for gold, what we call local London gold, spot gold, is traded in London, and that is basically physical. Okay, the other major markets that sets gold prices as a benchmark is the COMEX gold futures. I've been trading gold futures for a long time. In fact, I was a gold dealer back in 1989, and it was a very easy switch for me to trade the COMEX gold futures. So COMEX gold actually is a leading benchmark for setting futures prices, for setting gold prices. So if you are trading gold futures, then COMEX is the place to go to. Okay, and of course, because it is the benchmark, it has very deep liquidity. Okay, on a day-to-day basis, 27 million ounces are being traded every single day. Okay, so this makes it a place whereby you want to be exposed to because of the deep liquidity, and of course it's just very responsive to events around the world. Okay, so whether it's good news or bad news, gold will react, and you can actually take advantage of these events by trading the COMEX gold futures. Okay, principally there are the original 100-ounce gold. That was the only gold contract that was available back in the 80s. But over the years, you can see that the valuation of gold has actually gone up. Okay, when I was trading gold was on the average trading about $300 per ounce. So today we are at 2,000. Okay, so it's a big jump in terms of the value of gold. So what we call the original gold contract was 100 troy ounce gold contracts. The symbol is GC. The contract size is 100 troy ounces. Okay, and currently the maintenance margin for this particular contract is 11,500. Of course, the margin level will change based on the volatility. As the market becomes more volatile, the exchange actually reserves the right to adjust the margin requirement. Okay, so the value per tick for one lot is $10 for every 1 cent move. Do note that this settlements is based on physical delivery. So when you trade silver or gold, you must be very aware that you don't trade into the very last day of the contract, because you run the risk of actually either to delivery, either to deliver the physical gold or to take delivery. So you want to avoid that if you're only trading the price movements. And micro gold was actually launched 10 years ago, and this one is only 1/10 the size of the original gold contract. Maintenance margin likewise is only 1/10 of it, which is $1,150 right now, and every 10 cent move is equivalent to $1. So it's a very small contract. something that the retail investors will be able to take advantage of. Likewise, for settlement, it is physical delivery. Do note that the listed contracts are all even months for the 24-month cycle. Okay, currently we have US is no longer in daylight saving mode. Okay, half the year they will be in daylight saving, and half the year they are not. So right now the market will open at 7 o'clock in the morning till 6 o'clock in the morning. Okay, it's almost 24 hours except for the 1 hour break. Remember, the last trading day, okay, is the third last business day of the contract month, which is next month. So do not trade into the last few days of the contract. Okay, such to roll over when the volume for the next incoming contracts start to pick up. So you can see this chart here. The COMEX gold at the very top here is the 100-ounce contract. You can see the symbol is called GC. And if you compare the volume, okay, last October 2019 compared to this October, which is last month, the volume traded you can see is in the millions per day. I mean, for the entire month. So on a month-to-month basis, yes, there is a sharp drop in terms of volume, and that could be actually because gold, since after hitting the high of $2,289, has actually been more or less in a consolidation mode. Okay, so the run-up base before August obviously led to the boom in trading volume, but you can see that the liquidity is actually very deep. What we are interested in is not the mini contract, but the one at the bottom called the micro gold. You can see that there's an E-mini gold. The E-mini gold, the volume traded was only about 200,000 contract, okay, which is nothing compared to the millions that are being traded. For the micro contract, okay, you can see year to date at the very last two second last column, okay, you can see that the volume traded was 18.5 million contracts, and you compare that to 2019, okay, it's 4.5 million contracts. You can see that this gold contract, this micro gold, has actually increased in terms of volume traders, increased by threefold. Okay, 313% to be exact. So you can see that the increased interest in the micro gold has actually been very obvious. So you can see that retail investors have actually been very active in this particular contract. Now, early on, we said that this gold contracts, this micro gold is traded every even months for a 24-month cycle. You can see that the estimated volume for yesterday, estimated volume was 52,652, which is very good for a micro contract. Okay, obviously we can see the open interest is also very high. Open interest means position they are not closed. That means people are still hanging on to their positions, whether it's long or short. Okay, so you can see that the volume traded is actually very healthy. The next active contract after the December contract expires will be the February 2021 contracts. Currently, the volume is starting to pick up. You can see 14,800 lots were traded yesterday. So you can see the volumes are beginning to roll over into the next active contract. So if you want to trade the December contract, make sure that you don't trade into the last few days, start to roll over into the next, which is the February 2021 contract. Now, one of the key things is that CME have a suite of micro contracts, and because the reception of this particular class of contracts is so good, they have actually rolled out micro contracts for not only the precious metals, they are also rolled out into the currencies futures as well as the equity index futures. And these are the main micro contracts. And you can see that they are small specifically because the values of all these contracts has gone up so many folds. It's no longer possible for retail investor to participate. So for position sizing, what do I mean by this? Earlier on when I said if the 100 ounces gold is at 11,500, only very large capitalized investors can take advantage of this contract. Minimum that you'll put in to buy and sell 100-ounce contract is $11,500, which is not everybody can afford, right? But at $1,150 per micro contract, yes, then it allows you flexibility. Instead of buying one 100-ounce gold, now you have a choice to buy 10 micros, for example. Okay, and you can space them out the way you want it. Okay, different levels. It allows you to have more strategies that you can play. Okay, likewise, at 110, the contract size of the regular gold contract, the cost of trading also has gone down. The all-in commissions include in the clearing fee as well as execution fee. So typically the broker will charge you a one price commission, okay? It's what we call all-in commission. So that is become also very affordable to reflect the smaller size contract in the micro. And of course, needless to say, the margin requirement is also more affordable compared to the regular 100-ounce contract, which is 11,500 for maintenance margin. We need to say that if you want to hold a position overnight, you need to have at least $11,500 to trade 100-ounce gold. Whereas the micro contract, all you need is $1,150. Okay, so it is very affordable when you compare even to the E-mini as 5,750. Yeah. Okay, so in terms of capital wise, it is a better usage of your capital. And now it gives you strategic freedom because the contract is small, so it allows you to do a lot more. Meaning to say, instead of trading one in, one out, now you can say, okay, as the price goes, let's say for example, you want to buy, and ideally you buy at the price and the market starts to rally. But sometimes, you know, timing is always an issue. Either you buy too early or you buy too late. You don't get the best possible price. So what we can do is you can do averaging. Averaging is what we call scaling in and out. Okay, you have different levels in which there's a price range you feel that it is still worthwhile to buy, and instead of buying at only one price, you can scale in your contract size based on the strategy that you pick. You know, it gives you more freedom to choose different strategy. And then of course for intraday trader, those who have to trade by the day and exit by the day, they do not want to hold position overnight. The maintenance margin could be a lot lower. Okay, what I call intraday kind of margining if it's available to you. So you can see there is this advantage of trading a smaller, what I call smaller contract. Lately we can see there's a lot of this thing called fractional pricing. You can see that in equity markets. That means to say they create more decimal points. It means that the point value becomes more less pronounced. It allows you, the retail investors, to actually take advantage of different pricing mechanism. Likewise, the micro contracts in the CME also fulfill the same requirements. It makes it easier for retail investors to take advantage. At 10 cent, at $1 per 10 cent move is actually it doesn't give you sleepless night. Okay, compared to every 10 cent move is $10. I know, so you can see the difference here. So it's a huge difference. Allow you to trade with different strategy and not necessarily have to put in a lot of capital. Like I said earlier on, CME have a suite of micro products. Okay. When you have micro products, it means to say that instead of trading with limited capital on one asset class, now you have a choice of maybe trading one micro in gold, one micro in silver, one micro in any of the equity index, as well as in the currency micro contract. So it gives you more ranges of asset class to participate depending on what your view is. So you can see these are the key advantages. Now, what is the market outlook for gold at this moment? Over a longer period, you can see that this particular chart is a monthly chart all the way back to the 1970s. Okay, let me just say that gold contract has actually been trading for so long. Okay, you can see that overall, this is the way I analyze the markets, and regardless of what kind of market it is, I try to see it from a pictorial point of view. Okay, as far as I can see, this market is still very much in the bull run. Okay, the high traded was $2,089.28 in the front month active contract in the futures contracts. Okay, you can see that this is the record high. It has actually hit a minor target because there's a target at $2,077.80. The market went up to as high as $2,089.20 on August 7th. So the market is pulling back right now. But overall, if I have to give you a view, then I would say that gold market is basically still in a bull run over the longer term. Okay, the price that you can see on the left-hand corner of the chart, you can see $1,805.50. That was last night's closing price. You know, yesterday we have a bit of a bounce. Market went up on a close-to-close basis, up $6.70. Okay, this is the micro gold contract. Now, to give you an illustration, what the micro contract can do for you. Earlier on, I mentioned about scaling. Scaling is another word for averaging. Okay, those people who have traded equity will understand this concept because your entry price may not be very ideal. After you enter a position, the market will continue to go down, and you say, okay, this is still a good price to buy. Can I buy some more? If you have limited capital or if the contract size is stupid, you don't have this luxury of buying another one, for example. But if the contract size is very, very small, for example, the macro gold, then you can have the luxury of not using up all your capital all at one price point. You can actually scale in based on your analysis. Okay, outlook for gold. Okay, this is last week. Last Wednesday, I started to do the preparation for this for tonight's presentation. So I actually have based on that day's outlook, I actually came up with my analysis. So you can see at the bottom there, I highlighted that was November 18. That was last Wednesday. So the market was already retreating from a high of $2,089.20. So you can see the market is coming down. This is the daily time frame. I can see that the market is pulling back. Like the overall pattern that the market has pulled back from the all-time high is what we call corrective. Okay, and then you can see that there was one big long bar down in the days leading to the to November 18 closing, and that was when Pfizer announced the effectiveness of the vaccine. Of the vaccine. Okay, so the stock market went up again. Equity gold came off, and the market actually closed at $1,879.70 on November 18. And my view is that if the price can come down lower into a bracket like, for example, $1,694.70 to $1,770, okay, $1,770, okay, that area is where I think it will become very advantageous to go in to buy. Okay, so I have a very broad range to buy based on the daily time frame. Obviously, if I am speculator, that means to say that I do not necessarily have to use the daily time frame to pick my entry. I would normally go down to a lower time frame to pick my entry levels. So from this, I can see, as far as earlier on, you can see that this is the price. The market closed at $1,879 on November 18, and I believe the market has some more room to come down. So I have a choice. Either I do nothing, I wait for the price to come down to my ideal buying range, then I start to accumulate buying positions, or I can do the next thing, okay, which is to look to sell all the way down to those buy zone area. So you can see that the market after the big drop has been consolidating for days, and this particular day there was a sell signal, and this sell signal came in the range of $1,893. So you can see that if I have used a simple strategy like this, okay, I would have been able to scale it. What if the market continues to go higher? You can see the other levels at above the first level. You can see that it ranges all the way up to $1,952.60. You can see that those are areas in which I want to continue to sell, because I believe the market is still correcting, and I think it can still continue to go down. But at what point will be the best price? I get one selling signal, I took a position, I sell. But what if the market goes higher? Okay, so I have the luxury of using the micro contract to actually scale in selling. At every higher level, I can have the luxury of selling either one more or more relative to my earliest position. So that was the strategy. By scaling in, you can do that with a micro contract. Now, come to this week. This was the market up to last night. From where the market have the big sell-off, you can see that the market has actually gone down further since last Wednesday up to yesterday night. Okay, the market has come down today in the electronic trading session. The market actually bounced a little bit, but it is still not within my buy zone. Remember, my ideal buy zone is anything between $1,695 to $1,770. That range will be my ideal price to buy. Whether the market can go down to that level, I do not know. So I have to wait for the market to tell me. But if it does, then I want to look for level to buy. Earlier on, I was selling. Now I'm considering at this current price, I do not want to sell anymore. The odds has shifted in favor of buying, because the overall trend is still calling for up. Okay. So this is the 60-minute time frame. This is up to this afternoon. You can see at the lower range, you can see these are my ideal buy range. Like I said earlier on, the market may or may not go down to those levels, but if it does, I want to start accumulating by buying the micro gold at $1,741.30 onwards, and all the way down to $1,703. Okay, so those are the ideal range. So I could scale in buying at different level as the market dip further, if the market ever go down. Okay, But if the market doesn't go down and it starts to rally from here onwards, then again, I will have to relook my strategy and come up with a new formula. Okay, so basically, you can use a micro contract for such a strategy. This is a very simple strategy because the micro contract is actually very small. Like I said, each price point is only $1, so it doesn't give me sleepless night. I can actually, if I have let's say a $10,000 account, then I can have the luxury of playing this kind of scaling strategy. So what about silver? Silver volume obviously is not as high as gold. Gold on the average as of yesterday was 52,000 contract traded in one day, whereas the silver contract is at most a few thousand contracts. So relative to gold, the liquidity in silver is not as high, but it is decent. Okay. Likewise, you have three different kinds of contract. We have the regular 5,000 ounces contract, okay, and all the way down to the micro silver. The micro silver, the symbol is SIL, okay, the regular one is SI, okay. Then we have the E-mini, which is hardly has any volume, at QI. The QI we're not going to touch on because the volume is not ideal for trading. Okay, so you can see the graph on the left, the regular contract, the volumes are very big, and these are for the major hedge funds and refiners, because they are not likely to be trading the micro. The micros is actually engineered, okay, to cater to the retail investors like you and me. Okay, so you can see that on the year-to-year basis, you can see that year to date, 2019 traded 272,000 contracts. This time last month, okay, the market traded year to date, okay, 1.9 million contracts. So there is a six-fold, okay, increase in activity for the micro silver. Remember just earlier on the same chart I showed you for gold, the micro gold actually on a year-to-year basis, okay, has increased by threefold, 313%, whereas the silver, relatively speaking, has doubled what gold is doing in terms of the volume traded, okay, because it comes from a very low base of 272,000 last year. So you can see that this year up to end of October is 1.9 million contract traded. So the interest is there, okay, and there's a reason why the volume do pick up because of what we call the gold silver ratio. Later on, I'll briefly touch on it. Now, for those who are interested to trade the silver contracts, you can see that the silver contracts comes with two major ones. Okay, although there are three, we have the 5,000 ounces silver, which is the regular contract. This one is the 5,000 tri ounces. The maintenance margin is a lot higher than gold, which is 15,000. Remember, compared to gold, the regular 100 ounces gold is 11,500. This one is at $15,000. Okay, and the tick value goes by 3 decimal point. The last movement point, the 1 point move is 0.05 cents, equivalent to $25 US. Again, this is a physical delivery like the gold contract. Okay, the micro contract is again one-fifth the size of the regular silver contract, which is 1,000 tri ounces. The maintenance margin is $3,000 per micro contract if you want to hold it overnight. Now, this compare not very favorably with the micro gold contract, because micro gold contract, the maintenance margin is $1,150. So that could also explain why the volume in silver is not as high as in gold, because the margin required for silver is a lot higher, more than double. Okay, likewise, the minimum tick movement is 0.05, equivalent to $5 per tick. Okay, it is also a physical delivery contract. So again, do not trade into the last few days of the contract. Right now, the most active month is the December contract. You can see the volume traded last night was at 6,000. Okay, the next active contract, okay, you can see that is March. March is you can see the volume coming up to almost 1,009 contracts. So slowly, as the days goes by, towards the delivery contract for the December contract, people will start to roll over into the next active contract. Okay, again, trade only the active contract and do not trade into the last few days of the contract, because this silver contract like gold will end up with physical delivery. So the outlook for silver, this is again the monthly time frame. Monthly time frame all the way back to the 70s. You can see that there's two major peaks. Okay, the latest one was in 2000 and I believe 11. Okay, it's at $49.82. That was a long time ago. Remember the time whereby we have the Gulf War? Okay, that was when the silver market went up to $49.82. Okay, the most recent move down in 2000 was at $11.64. Okay, now the market is having a rebound, but unlike the gold market, the long-term outlook for silver is actually bearish. So we have bullish outlook for gold and bearish outlook for silver. Okay, so if you should decide which one to buy, should you buy silver more or should you buy gold more? So you have to look into the overall trend, look into the why both precious metals are not necessarily in sync. Okay, whereas gold is trading at record level, silver is very far away from the record level. So this is the outlook. So what we are seeing for the rebound from the $11.64 is actually what we call a rebound. So it is a rally within a downtrend. So in the 60-minute time frame, at this current price point, okay, I no longer see current price point as ideal for selling. In fact, the price has gone into what I would consider on the 60 minutes time frame, a level in which I will be more keen to buy than to sell. Okay, this price point range is between $22.62 to $23.34. This is the range in which I want to consider buying. And you can see the most recent lows at $22.93.5. Okay, so when you are trading, you must always understand what are the probability. Market may be downtrend, but it doesn't go down all the time. At some point, you will have to bounce. Okay, so timing is everything. So you have to make sure that when you decide to buy either in the short term or long term, you got to make sure the price that you pick is in sync with your market outlook based on the time frame that you want to trade. Okay. So earlier on, I did mention this thing called the gold-silver ratio. When is a good time to buy gold relative to silver, or when is a good time to buy silver relative to gold? You can see on a historical basis, all the way back into the 70s, gold and silver ratio means how many, what it means is basically very simple, okay? It's self-explanatory. Gold-silver ratio represents the number of ounces of silver it takes to buy one single ounce of gold. So you can see that if the price goes up to if the ratio go up to 109.55 in May 13 this year, it means it will take 109.55 ounces of silver to buy just 1 ounce of gold. You need more silver to buy 1 ounce of the same gold. So it means that you require more, right? So the ratio will give us an idea. It is not science, but it is an observation. Each time it goes near to 100 or exceed 100, it becomes more advantageous to buy silver relative to gold. If gold-silver ratio is on the low, let's say 30s, for example, then it makes sense to buy gold and not buy silver. But if the ratio goes up to 100, the ratio, it means the relationship will flip. It becomes more advantageous to buy silver relative to gold. Okay, so you can see that the price of gold actually rebounds recently, right? So there was this gold-silver ratio in play. Okay, you can see this. Historically speaking, has never been wrong. Anything above 100, you want to buy silver relative to gold. Okay, and if it's on the lower 30s, even the lower 20s, then it is more advantageous to buy gold and forget about silver. Okay, so in summary, going forward, we have more or less settled the US presidential election almost. Okay, we should know by in 2 more weeks, okay, who will be the one going to be the next incoming US president, okay, whether Biden or whether Trump. Either way, whoever is going to be the president will have to deal with all the myriads of problems that I highlighted earlier on. Okay, we have high unemployment rate, we have high national debt, okay, we have to deal with high bankruptcy rates. So all these are things that they will have to deal with, whoever is going to be in power next, okay. It has been very eventful so far this year. The following months and years is going to be even more challenging because everything has come to a what we call an inflection point. Okay, the problem that we faced 11 years ago, I'm talking about the global financial crisis. The policies that has been enacted, okay, has basically caused the problem to snowball. Now the problem has become more intractable. Okay, they have tried a lot of unconventional monetary policy. They have tried ultra low interest rate, even negative interest rates. The economy just cannot bounce. They pump a lot of liquidity into the market in terms of creating more money supply. The economy is not doing well. And then this year we have the COVID-19. This could be the last, maybe the straw that breaks the camel's back, okay, so to say. COVID-19 is going to be monumental because the impact it's going to have on the economy is going to be so massive. it may never be fully be able to solve. Okay, so going forward over the next few months and years, we can see that I would think that financial markets will become even more challenging. So if you're invested in equity, you got to decide, okay, do you need to do some kind of sector rotation? Do you still want to rotate over into a technology stock, for example? But if you are not in equity, what else can you put your money? Everything will move, okay? Because financial markets are interconnected, okay? So for one piece of news, everything will move, okay, based on the correlations. You can see that financial markets do move, and futures and option markets are financial products that is actually very tailored towards capitalizing on all these, whether it's a short-term or long-term move, because they are very responsive. So beyond metals, like I said earlier on, CME have a suite of futures and option products which you can actually participate. Okay, ranging from agriculture to interest rate to soft commodities to debt instruments like bonds or interest rates. You can basically take advantage of all these different products, and the one that is currently the flavor of the month are all the micro contracts. These are basically designed to cater to the retail investors. So there you have it. Now, if you want to know more about markets, and you can always follow me on my these various links. Okay, I have 2 Facebook pages. One is my personal and the other one my company, or you can follow me on my LinkedIn. Likewise, if you want to know more about my background, you can actually go to Kinokuniya. There's an online shop in which you can buy my book. This book is just been released recently. I believe it was selling for about 70 ringgit. So there you have it.
All right, great. Thank you, everyone. Should you have any further queries, please feel free to drop us an email at bcrm@kenanga.com.my. We appreciate you being here and hope that you enjoyed the webinar today. Please take a minute to rate our webinar, and your feedback is highly appreciated. Thanks again for joining us, and hope to see you again in our next in future event. Stay safe, everyone, and good night.
Good night.
What are you clicking?
Click KenangaFutures.com.my, Malaysia's leading derivatives broker.